Hi, I'm Marty Switzer. Welcome to Switzer Investing TV. On today's show, we're going to speak to Grady Wolff from Bell Direct on markets, reporting season, and how she's investing right now. We're going to hear an interview between Peter Switzer and Paul Black from WCM Investment Management, and also make mention of a special offer to invest in the WCM Active ETF. And we'll hear from Luke Hopewell, our head of content on AI, CBA, and big business. Thanks for watching. And now we're going to talk with Grady Wolff from Bell Direct on the markets and what happened today. Welcome, Grady.
Thanks for having me, Marty.
So, Grady, markets are at or near all-time highs. What do you see as the key drivers of this market to keep it elevated?
It's quite a few right now, but it all comes down to the rate outlook in the US and any form of stability on the horizon for investors on a global scale. Because in FY25, as we've seen in the results season most recently, we've seen so many hurdles have had to be overcome to even just meet expectations on an earnings front. We had Trump, we had tariffs, we had geopolitical tensions, we had inflation elevated, we had high interest rates, we had subdued demand, we had China's economic recovery. So much at play in FY25 that the now investors just want to see some stability in FY26. That's exactly what's being delivered from not only Jackson Hole on Friday with Fed Chair Jerome Powell signaling that they can start thinking about cutting rates again. We've got these tariff implications coming down, they're easing. We know what they're going to impact inflation is. It's not set to be as bad as we first expected. And investors and consumer demand is increasing again. Our inflation journey is under control. So the stability is the big factor that investors have been looking for quite some time. And finally, we are seeing it come through in FY26. So it is setting the foundations for a really strong year ahead. And that's exactly why investors continue to rally markets globally to record highs.
It doesn't want to sell. What do you think are the key risks or catalysts that investors need to be most mindful of at the moment?
Yeah, I think Trump is still a risk in himself because, as we know, if he's not in the news, he doesn't like it. So while there is stability right now and there is silence on the Trump front, we do need to keep in mind that he could throw some curveballs again. The inflation journey, while it is one right now, it isn't one forever. So, what I mean by that is that it could still rebound, it could still go up again because of different macro factors that we need to keep in mind: wages, price inflation, consumer demand, trade wars, trade tariffs, all these things that impact inflation. So that's how, while we have one at now, it's not one forever. So it's something to keep in mind. And that's why obviously the RBA has taken a much more cautious journey as opposed to cutting just for the sake of cutting. Now, there are other catalysts on the horizon. We want to see material stimulus come out of China and material growth and sustained growth coming out of China over the next coming months. Because for many years now, I think it's 2 years now, we've been promised this material stimulus that has just not flown through to economic stability and economic growth in the world's second largest economy. So what that means for us, it's flown through to poor results again in FY25 for a lot of our big miners. But thanks to diversification, we've seen their results boosted up. So BHP in copper, the outlook for lithium to rebound for Rio, and a different green energy transitions there. But China's economic data will definitely have a hawk eye. Investors will be very closely watching it over the coming months because we need to see that material turnaround. So I think that's something to keep in mind.
For sure. Now, I'm keen to get into earnings season, but before I do, you mentioned it before briefly, but in terms of the catalyst, do you think the tariff story's still got more legs in it?
I think it's kind of everyone's sick of hearing the word tariff and everyone's sick of hearing the word taxes now. So I think it is well embedded into the market outlook. It's well embedded into investor outlook and forecast. And every company in this reporting season has much of a muchness just said, this is the impact. This is what we expect. This is what we're allocating towards it. Or if they don't know it or aren't impacted, even better. So that's what investors are looking at. They're priced in. Yeah.
So reporting season, themes, surprises, and I guess what you've been impressed or not impressed by so far in terms of results.
Yeah, for sure. So I think overall it's been what we expected. We went in with a pretty low bar because of the headwinds that I mentioned at the start of our recording here today. So the headwinds were high. They did mount. There was a lot of challenges to overcome. So growth was in the either low single digit or no growth at all for earnings. But those that did produce really strong earnings results were rewarded with double digit share price appreciation on the day of results being announced. So I think the surprises for me were the retailers remaining resilient because we had that high interest rate environment, high cost of living pressures, but consumers still spent money. Like, look at baby bunting. JB Hi-Fi, Nick Scali, Temple and Webster, areas that we thought would be the first on the chopping block. These are the ones that really surprised this reporting season and continue to do so with a strong start to FY26. So I think it's the niche retailers who continue to surprise me year on year, but a really good result across the board of those ones that I just mentioned. The insurers did pretty well as well. I think we saw some out today. In the insurers, there's been higher premiums that we're all paying, but less claims and less weather events that we've seen as well. So that's really boded well for our insurers out there.
Yep.
With cost management was a really big thing that investors were looking at, where I was looking at this reporting season. So cost management, if you weren't managing costs well in terms of increasing your prices to enhance the margin appreciation as opposed to depreciation, that was something that was really crucified this reporting season. And I think outlook is more crucial than ever because as I said, we've had so much murkiness in the water and investors have had no clarity on what the outlook's been. So we need to see that FY26 has some sort of guidance range for growth on the horizon for a lot of these companies. And for companies that did cut their guidance or failed to give any guidance, we have seen them punished quite heavily. And finally, obviously, dividends. Dividends were cut by Beach Energy, but they were increased by ResMed. So again, companies able to manage their costs were really good at rewarding shareholders this reporting season.
And in terms of this week, the last week, so it'll be a big week, results we should be looking out for?
Yeah, Qantas is one I'm going to keep an eye on, especially on the capex front, because as we know, they've got quite an old fleet that they need to deal with. So I'm going to look at the capex outlook and how they're going to manage that cost over the coming years, as well as their market leadership with Virgin now back on the market. Well, not on the market, but on the listed market. So investors just seeing how they're swinging between the two leadership players there. Also looking at WiseTech Global, how the company is looking heading into FY26. They're acquisition kings over there. They've done 55 over the last decade. So just seeing what their outlook is with the CargoWise product that they're dominating around the world in the logistics space and how they're performed in the last year. Domino's Pizza, not one I'm very much looking forward to, but just one that I want to see a bit of a turnaround on. It's been quite an underperformer for quite some time. So if there is an turnaround strategy like we saw with Southern Cross today, Southern Cross Media, that is, sorry, today, their investors were really impressed with their turnaround strategy. So Domino's might follow suit, and obviously Coles and Woolies as well out this week. So I like to look at both the supermarket giants to see who's outperforming who, but I have a feeling Coles might do a little bit better this reporting season.
Yeah, important holdings in a lot of our clients' portfolios. Now, in terms of AI, what sort of themes have come out of this reporting season? It's been a hot topic in boardrooms.
Oh, it is a hot topic, and if you're not in it, then then you're missing the train. No, but a lot of investors have been looking for AI exposure. A lot of people think they've kind of missed the boat, but they haven't. We're looking at the data center play, Goodman Group, and their expansion into data centers. That's kind of the diversified way in which we're playing the AI theme at the moment. We're quite bullish on Goodman Group with a buy rating. I like their expansion, what they're doing on a global scale, because they already have the facilities for these data centers. Like in Hong Kong, it's the logistics centers that they're literally just putting data centers on top of, which is simply amazing. And also, just be careful when you're looking at the AI exposure this reporting season, because a lot of companies say they're investing in it, but when you look at the financial statements, they might not have allocated any money to it. So don't get caught up with looking at the kind of the hype of the AI and in the highlights of the reports. Make sure you look down into the financial sections and see what costs are allocated to AI and how much they're going to benefit from using it.
Yeah, and I think ultimately for most investors, you think it's fair to say that notwithstanding the great top line growth that potentially can come from this, I think a lot of investors will look at it and say, well, what can this do on the cost side?
Yeah, the cost, it's a serious game of cost outweighing efficiencies. So if the efficiencies coming through are only going to give you, say, low single digit earnings growth as a result of such an input into the AI space, doesn't really make sense. And if your terminal growth rate is less than 5%, there's no kind of point in doing it. But if it's really going to enhance your growth, your margins, and reduce your costs, then go ahead. That's exactly where you want to see the benefits coming through.
So we get through reporting season this week. Stocks and sectors you like over the next 12 months?
Yeah, AI is definitely one. I think the theme isn't fully at its potential yet. There's definitely momentum there and tailwinds in that space. I think the healthcare companies have been quite unloved for quite some time since COVID. I think there's some really big catalysts coming out in the coming days and coming weeks, and some trial results that I'm waiting for. Clarity Pharmaceuticals, I'm waiting for some of their trial results to come out. A fantastic company there working in the cancer imaging and therapy space. And Neuron Pharmaceuticals is the second drug currently in phase 3 trials. So those are two that I'm watching at the moment. The retailers, the niche retailers, I still really love. I love the fact that they've just continued to outperform expectations and defied expectations. I also think that the energy space, materials space is going to come back through. We've seen the small to mid cap space with there's an undersupply at the moment and a really strong undersupply outlook for copper to come, with the producers really drying up and high grade. There's not enough high grade copper to meet this green energy transition. So I think copper producers in the small to mid cap space are going to really run over the next 12 months.
Grady Wolff, thanks for your time.
Thanks so much for having me.
Thanks, Grady. We're now going to go to an interview with Peter Switzer and Paul Black from WCM Investment Management that was recorded last week. And for those that don't know, we've got an offer running at the moment for the WCM Exchange Traded Managed Fund, ASX WCMQ. Any investor that decides to invest in the ETF, whether they're a new investor or an existing investor, will be paid a 1.25% loyalty bonus if they stay invested for 12 months. The fund's got a fantastic track record. The strategy has achieved almost 15% a year since 2008, and it also pays income on a quarterly basis with a minimum cash distribution of 5%. We'll now go to Peter and Paul.
Can you just give a background of who you are personally? What is this business? And, why is it your style of investing quite unique?
We are a $115 billion asset management, money management firm, and we're known around the world for running global equities. We've got a very enviable track record over 15, 20 years. We've been doing it a long time. And I always think of our firm as a bunch of people who are complete learning machines, always trying to iterate and get better at our craft. And that's proven to really be the case, especially in the last few years when the markets have been very, very difficult. We actually bought this firm in 1998 from the original founder when it had only $200 million under management. A lot of what we talk about, and we'll talk about it, I know, Peter, is around people and culture and how important that is to anyone's success organizationally. And that's the gift the founder gave us, because he was a completely toxic person with a very toxic culture that crushed the hearts and soul of the people there. And we actually learned from him what not to do. And we've created something really special here in California. Look, every organization is about people. People like to make these stereotypes about these inanimate objects called corporations. But the reality is people make up those organizations. And what we look for is we want to find the set of values in the organization, what those values happen to be. We look for alignment between the values and what they're trying to do on the strategy side. That's really important. So in a retailer, for instance, a great retailer, every great retailer you and I have ever walked into has happy employees, right? Because it's so obvious. If you have happy employees, we're going to have great experience. We'll come back, shop more, and the shareholders would do better. But that may not be the right corporate values for an industrial company or a tech company or even a railroad company. They're going to have very different values. But the key point is every company has a set of values, and what you try to find, and we try to find, is an alignment between the values of the business and what they try to do on the strategy side. And the reality is, when I talked about the founder early on, about how difficult he was, the gift he gave us was how important culture and people are to the success of an organization. We've got to fix this culture that's highly toxic. How do we do it? Well, what would the founder do? Let's go 180 degrees the other way. We'll probably build a really nice, healthy culture. So he owned all the stock. Let's build a company where, now 67 people own shares in the company. That's magical, because when people own shares, they behave and act very differently. They act like owners. Pay was very opaque. Let's make pay very, sounds basic, but let's make it really transparent so people know exactly how they're going to be compensated. And there are real metrics there. And then in terms of, I tell this really funny story. Every day he would walk in the office and we had 12 people at the time. And he'd walk back to his office and he'd close the door at 8:30 in the morning and wouldn't come out until he left at 5:30. And the only way you could talk to him is he had a mail slot on his door. You'd have to write a little note and say, "Hey, Daryl, can I ask you a question?" Put it through the mail slot, and he may or may not answer it. You may just sit there for 15 minutes waiting for him to answer. Well, we went as far away from how we ran the company as we possibly could, and we empower people. We try to get people into the areas of genius. We care about people. It sounds so basic, but if people know you care for them, they'll give you everything they have. And as a result, we started to grow. And then a few years later, it dawned on us, my gosh, if this made such a difference to us, we ought to start doing this with the companies we invest in.
You are a sharing, caring kind of guy, Paul. How does someone, identify a company with good culture?
It is a lot of work. Everyone thinks, we can talk to any CEO in the world because, we're big enough. We own enough. We're probably on the top 10 shareholders of most of the companies we own. They're easy to access for us. But those aren't the people you want to talk to, right? Because you're going to get a scripted response. Your best responses come from the line workers and like you said, standing outside the factory when the factory closes down and asking a series of questions. That's a brilliant way. So vendors, people that sell to them, competitors. We love to ask one company, which competitor do they fear most and why? So again, this is work that takes months and months of time to do from 4 people. But you do start to create an incredible mosaic of what behaviors are honored in the organization.
So let's talk about another company that's been fairly important to you this year, AppLovin. What's the growing competitive moat that you see there?
So what AppLovin does is they actually created the advertising for mobile games. So if you ever play a mobile game and on your phone or your iPad and an ad pops up, that has been created most likely by AppLovin. That's what they're known for. And sometimes they're annoying, but they work. So they have figured out an algorithm where they say, okay, the average age of somebody playing this particular game is 35. So this is the right ad to associate with that game. You and I, Peter, they're going to sell us geriatric, ads all day long because, we're going to play games that the older people play.
Luxury cruises, Paul, luxury cruises.
Luxury cruises. I like that better. But they literally have built an algorithm using AI that it's a kind of a black box, but it works brilliantly for tying advertisers to the players of the game. It's been very efficient, but this is why it's so exciting. The reason we're so excited about it is they are now moving into e-commerce. So they're going to take that model that's worked really well from mobile gaming, and they're going to now go into e-commerce and with this same algorithm that's just crushing the competition. And so the market for them has gone from maybe this big to this big. They have been brilliant at taking market share across the board, and they will continue to take it as they move into e-commerce. So in 2022, we didn't just sit there and say, this is what we always do, let's just keep doing it. This is the time when we have to separate ourselves from the pack. The way to do that is, in our mind, was to really think more of where are companies inflecting upwards from here. Now, this is like at the trough of 2022. Where are companies starting to inflect? It may not just be in technology. It may not be in only healthcare or consumer names, which are the names that most growth managers own. And when we started doing that work, looking for companies that were inflecting upwards, about 3 years ago, we found that, aerospace is an interesting space. Most growth managers don't buy aerospace. We have an aging fleet of airplanes across the globe, and they're going to have to be replaced. And companies that supply parts for those airplanes are probably going to do pretty well. So we made some investments in aerospace that have just performed beautifully. Defense. Now, this is really interesting. European defense in particular. We started looking at the European defense companies, and we started to see these inflections upwards in their financial performance. And, of course, now, with Europe having to arm itself and actually invest more in defense companies. We were very, very early to that general idea. We continue to own those names. We think that, and they've done, we've got a couple of companies that are up 200 or 300% in 2.5 years in the defense area. Even things like gas turbines, which, oh my gosh, growth managers don't buy gas turbines, but why would you buy that? Well, data centers. I mean, I'm sure Australia is building data centers everywhere they can find space for them. They use a massive amount of energy.
Paul Black, you're not only a great fund manager, you're actually a great American. And I don't say that to many Americans, you know that.
Well, I have an American flag behind me, and you can see I turned it around so it wouldn't annoy your people.
Thanks for joining us, mate. Thanks for joining us.
Thank you. Great to see you, Peter. Take care.
And we'll hear from Luke Hopewell, our head of content on AI, CBA, and big business. Luke Hopewell, welcome.
Thank you. Great to be here.
So look, we're here to talk about AI, an area where you've got a lot of expertise in. Before we sort of get into, I guess, the current landscape, who the players are, who you see the winners are at the moment, the trends that have been occurring.
Sure.
There was a big story that you actually wrote last week on Switzer Daily around CBA and what they were doing with regards to one of their AI initiatives and the FSUs involved.
Yeah, definitely. There's a hearing set before the Fair Work Commission on the 25th of August, despite the fact that CBA's admitted a bit of a misadventure in their AI antics. Basically, 40 to 50 call center staff will let go, saying, thanks for playing, but we think the robots can take it from here. Apparently, according to people in the call center that they were looking to redeploy the robot into, it led to supervisors having to jump on the phone at all times. It led to huge bottlenecks in the queues. And CBA's come out and said, look, we need these people back. And to be honest, I think it's a really good thing that they've had the ability as Australia's largest employer to basically stand up and say, you know what, we're experimenting with AI and we haven't got it right on this one. We need the people back. I think AI is definitely a tool that can be used in conjunction with people rather than replace people at the moment. But c'est la vie, and it's good to see that these people are going to get their jobs back and customers are going to get decent service.
And there's a big conversation going at the moment about, you've got AGI, artificial general intelligence, basically saying that artificial intelligence can be smarter than humans. But then I guess the other conversations going on at the moment is this whole sort of augmented AI. And so in order for AI to work best, you need a blend of people and AI.
Yeah.
Thoughts on that?
Yeah, I think that at the moment it's not at that sort of AGI level. The artificial general intelligence is really defined by the ability of this program, this learning model, to do that stuff as intelligently as a human and really have that independent level of thought as what it needs to build. A lot of the models now, you see them being very, very advanced. Some of them you actually see being kind of dumb, where they're still just sort of predicting which word should go next. Like they're just trying to catch themselves before they fall over.
When you talk about the models, for those that don't know, there are a number of players in the industry, and the models we're talking about are what they call LLMs, or large learning models, which effectively is the way these information is produced. And so you've got some players, you've got OpenAI or ChatGPT, which has been sort of, I guess, the one that's been most progressed in the journey.
And probably the most recognized.
Probably got the best product and best brand. But then you've got other players like Anthropic. You've got Google in the space through Gemini. You've got Perplexity, which is trying to launch a browser at the moment.
Yeah, definitely.
Chrome. You've also got Grok, which is obviously part of Elon Musk's universe. He uses sort of X and AI and Twitter to scrape a lot of the content, because all this information is effectively being scraped from the web.
Correct.
So the players that have got content depositories are going to set themselves up well. And one of the themes that's being discussed a lot at the moment is that ChatGPT 5's come out. ChatGPT 4 was seen to be unbelievable.
Really good.
I guess there's been disappointment about 5.
Yeah.
But Grok as well has really seemed to, I guess, jump up and maybe now is challenging ChatGPT. Your thoughts?
Yeah, I think that the Grok's an interesting one. If you can hold your nose around the stench of Elon Musk, it's definitely something that's one that's going to impress. Like you said, it's nicking everything from Twitter users and from X users. I'll never call it X. I'm sorry, Elon. But the service itself is very interactive. They have a built-in user base that are constantly training it. The real problem that you find is with who's building these things and whether the guardrails are there. So You mentioned Anthropic before. There's Claude, all these sorts of things.
Anthropic.
All of these things have ChatGPT
Really?
as well.
Google and Anthropic?
So Anthropic is currently a name that's being tossed around between both Apple and Google as Apple looks to improve its Siri product, which has kind of been left in the dust a little
But
bit.
is Google own part of Anthropic?
They may. I'm
That
going
ownership
to have to
is in
check.
there,
Yeah, they may. But Apple may be looking to make a big acquisition there. But
Well, they're the company that everyone talks about has no AI strategy.
certainly,
And
yeah,
if you
yeah,
look at sort of, I guess, where the players are and who's sort of best set to win the AI war.
correct.
Everyone obviously talks about ChatGPT, but if you look at like big tech, for example, X,
Yeah.
Meta,
Mhm.
Zuckerberg signing $billion contracts to
Yeah.
get sort of AI experts,
Microsoft as well.
and then Microsoft through their investment in ChatGPT. But Apple's sort of nowhere at the moment, are they?
Yeah, so Apple's sitting on about, at last guess, $200 billion worth of cash. That's not just assets, that's cash. That they can sort of buy their way out of trouble. They kind of treaded water for a bit too long. Siri was the first sort of personal assistant that was out there, but
Which is ridiculous.
it's rubbish now. I'm sorry, Apple. It really is terrible. It doesn't understand me in the car at all. But they're looking to make a big acquisition, hopefully. And news came out this week from Bloomberg that they're even talking to Google about employing Gemini to help run some of their Siri AI stuff. And it wouldn't be unheard of because Google's received checks from Apple before to be the main search engine that's on the iPhone. So the sworn enemies can cooperate if the price is right.
And there's also, I guess, a bit of a narrative building that all these models or LLMs
Yeah.
are all a bit different and all good at sort of different things. Like,
Correct,
I
yeah.
guess ChatGPT has probably been the main player, but then I think the viewpoint is that things like Anthropic and Claude is very good for coding,
Yeah.
where things like Perplexity are very good for data and information. Do you think it's a world where eventually we've all got a few agents who are sort of working with us and having different areas of expertise,
And
like
this is-
team members
Yeah.
particularly?
And this is where I can bring it back to something for our viewers and something for investors is when you look at different AI tools that the corporates are using, really have a think about the engine, the model that's powering it, because there are different things for, like you said, for different tasks. GPT-4 was really, really good at writing stuff, for example, but GPT-5 is definitely better for sort of less personal data analysis stuff.
Yeah.
Claude from Perplexity is fantastic for writing code.
Yeah.
Whereas previously you'd need to spend X amount of
Anthropic,
dollars.
Claude's from.
Pardon me, Anthropic.
Yeah.
Whereas previously you'd have to spend X amount of dollars to hire someone who can build apps for your company. There are people that can vibe code their way through it now with the help of Claude Code. So there's a lot of dividends to be paid, and definitely, like we heard Grady Wolff say earlier on the show, go and have a look at those balance sheets to see who's actually spending and what they're spending it on, to make sure they're not trying to sort of white label their way to a good result season through AI.
And before we go, for any viewers that aren't using that are not using AI yet, how would you recommend that they give it a try?
Yeah, if you're not using AI just yet, lucky you. But I think the real way to use it, I think, is just to get hands-on. Remember that it is truly natural.
Choose one, stick with it,
And just figure out where you're, where you're best going to navigate to. All of them will offer a free plan. ChatGPT's got a fantastic free plan, and all these things learn from you. So if you want to stick around and let it learn from you and generate memories, it can pull on stuff that you've talked about before to help build on different projects. So
the price is pretty reasonable still, isn't it?
yeah, not too bad. You'll get one from about $20 US a month. And it's definitely helpful, especially if you're an individual contributor in a business or a small business owner looking to maximize your strategy.
Luke, thanks for your time.
Marty, thank you.
That's the show. If you haven't signed up for our YouTube page, click on that and you'll be able to watch the show on YouTube every week. You can also watch the show by signing up to our newsletter at switzer.com.au. I'm Marty Switzer. Thanks for watching.